Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is your Cannabis Business Podcast. Here's a report from ELLO and MGO CPA, a roadmap for cannabis industries, IPOs, and RTOs, how to go public in Canada. There are as many reasons to raise capital as there are companies seeking to do it. The proceeds can be used to expand existing operations, introduce new product lines, enter new business markets or states, acquire other operators or license holders, invest in research and development, pay down debts and improve financial health, and so on. In Canada, medical cannabis has been legal since 2001, and adult use cannabis was legalized nationwide in 2018. The legality of cannabis in Canada, plus a welcoming regulatory, financial, and investment environment, has made the nation home to a number of large cannabis enterprises. This has all led to the growth that's been fueled by the ability to access capital via public listings. The two most active exchanges, the Toronto Stock Exchange and the TSX Venture Exchange, are proudly home to a number of large cannabis companies. But similar to their peers in the US, they currently impose restrictions on listing companies that have plant-touching US operations. The Canadian Securities Exchange is an alternative exchange focused on micro-cap and emerging companies. The CSE calls itself a modern and efficient alternative to companies looking to access the Canadian public capital markets. As a result, the CSE offers simplified reporting requirements that lower the barriers to listing. Perhaps most importantly, the CSE has taken a progressive approach to the cannabis industry and does not block companies with plant-touching U.S. cannabis operations. As a result, the growing number of U.S. businesses are seeking to list on the CSE. The emergence and subsequent rise in value for cannabis companies listed in Canada has been a highly discussed topic for the last several years. Cannabis companies seeking capital know that listing in Canada will earn attention. As a result, a feedback loop has developed where investors seeking growth opportunities look to cannabis companies in Canada, and cannabis companies seeking capital know that listing in cannabis will earn attention. The trend of cannabis companies going public in Canada has also created a network of essential resources for companies seeking a listing. Going public requires support from a strong team of accountants, lawyers, investment bankers, and other advisors who guide every step in the complicated process. It's necessary to find professional service providers in both the US and Canada who have experience performing this transaction with cannabis companies. There's a cost-benefit analysis to anything, and going public is no different. So the advantages of going public is future capital raises. Once public, you can use that public market to raise additional capital at a later date, normally at a higher valuation than a private company. You have improved public awareness. Going public can be a highly publicized event, raising awareness and earning headlines that introduce products and services to an entirely new audience. There's acquisition of talented staff. Going public can make the company more appealing by offering equity ownership options to act as a motivational and retention tool. You have securities used for acquisition. Publicly traded shares can be more attractive to a seller than shares with no ready market, giving an advantage in negotiations. The disadvantage is increased scrutiny. Public disclosure rules require sharing business details. Regulatory authorities, the public, and your competition will examine that information. There's regulatory oversight. You have meeting, reporting, and regulatory requirement demands a significant commitment of time and resources. You have reduced management control. As a public company, corporate decisions require approval from the board of directors and or shareholders, and it's an increased cost. There's a process of going public requiring a significant investment. The demands of operating as a public company create a continuous incremental cost burden. And you have equity dilution. Going public involves selling ownership stake to the public, and depending on current and future valuations, existing owners and investors may be diluted. And you have to weigh the time. After weighing the pros and cons and considering the impact of your company, the next step is determining the right time to go public. Capital markets rise and fall in cycles, endure technical corrections, run in streaks with or against particular industries, and also react to unpredictable political and economic events. Judging timing is equal parts science and art, with the ultimate goal of entering the market as it apexes in your favor. There are two main options for going public: an IPO or an ITO, the initial public offering or a reverse takeover. An IPO is when your private company prepares and files a preliminary prospectus with the applicable provincial Canadian securities regulators and the CSE. After completing rounds of review, you file a final prospectus. Upon acceptance, your shares become available for purchase by retail investors. Whereas an RTO, or reverse takeover, is when your private company is acquired or merges with a public shell company already listed on the CSE. Via an exchange of shares or other assets, you can gain majority ownership of the ensuing entity and its listing. The filing is only reviewed by the CSE. Shares of the entity can be sold via private placement and to the investing community. If you're trying to determine whether you want an IPO or ITO, there's some factors to consider like time. If you're in a hurry and you want to trade as fast as you can, you want to do an RTO. If you're not wanting stock dilution, look for an IPO. If you're looking for less due diligence, go with an RTO. If you want stronger liabilities, look for an IPO. If you care about stigma, doesn't really matter. If you want something that's fast in terms of timing for closing financing, look for an RTO, as well as cheap costs or less expensive costs, around $850,000 approximately for an RTO, and a IPO is around $4.2 million on average. The capital potential has a benefit more towards an IPO. There are no limits to the amounts of potential capital raised, but IPOs are commonly considered higher profile and may be more appropriate for larger capital raises. It's ironic that you're trying to get capital and yet it costs so much money to go public in Canada. So getting your cannabis company ready to go public requires significant expenditure. These costs may vary considerably depending on the size and complexity of your cannabis business operations. You're going to need to have auditing and accounting. So going public requires the disclosure of financial and operational details. Two major components of this are historical financial statements and reviews of interim periods. Legal fees are incurred when you're drafting the required filing documents, preparing material contracts, affecting, restricting, and completing due diligence procedures throughout the transaction. Marketing costs. Sharing your cannabis company's value journey is an essential stage of going public, and creating awareness in public and financial markets will be an important factor contributing to the success of the effort. So you'll incur significant expenses in drafting and distributing listing offerings, documents, and mounting a successful roadshow. So if you choose to file in Quebec, you'll be required to translate essential documents into French. There are other costs. There's filing and listing fees, securities commissions, preparing evaluation reports and other technical reports, indirect costs of leadership and staff supporting internal efforts. There's an underwriter's commission. One of the most significant expenses associated with an IPO is the underwriter's commission, which can vary anywhere from 5 to 7% of the offering and is subject to negotiation between you and the underwriter. Caveat though, that's only if you do an IPO, an RTO, you don't have an underwriter necessarily because you're already buying something that is public. But other factors that are included are a natural underwriting commitment, current market conditions, type of security sold, industry and market comparisons. So again, one large advantage with an RTO option is that it may not be necessary to engage in an underwriter for completion of the transaction. Another fee is for tax advisors. So your company needs to undertake certain restructuring activities in preparation for going public, and you need to operate as a public company. So you need a team of experienced tax advisors to guide the restructuring process and ensure your company is in an optimal tax position. There's some RTO costs. Depending on the nature of the RTO transaction, there may be a cash payment involved in negotiating with the shell company. Other costs unique to the RTO will include the extensive due diligence performed on the shell company prior to completing the transaction. You're probably going to need to take a long look in the mirror and decide, is your cannabis company ready to go public? Once you've gained a significant understanding about the process involved in going public, the time and resource commitments needed, the impact this process will have on your company, then you'll be ready to make the final decision. The exact timing of the process necessary for going public is determined by a number of factors, including the complexity of the offering, the readiness of your cannabis company, and the timing of industry and market trends. The following is a recommended timeline that proves ample flexibility to assess and prepare for the issuance. With 12 months, finalize long-term business plan. You want to first finalize a long-term business plan, assess corporate governance and reporting requirements for public companies in Canada, understand the listing requirements for the CSE, establish an internal team responsible for managing the IPO or RTO, review accounting policies and historical financial records, assess the internal controls and financial reporting systems and upgrade where necessary, determine whether to seek an IPO or RTO, and then assess a board of directors and begin the process of strengthening the team. You want to perform audit reviews of financial statements and perform tax compliance reviews with choosing an external advisor for the underwriter, the legal counsel, the auditor, the tax advisor, and the IPO or RTO readiness consultant. Filing a reverse takeover isn't as glamorous, but there's a reason that High Times and other companies do it, is primarily because it's less expensive, there's less regulatory oversight, And all in all, it's just an easier, cheaper process. It was once considered a backdoor entry to a public listing, but now the RTO has emerged as a viable and in many cases preferred option to the IPO. As a result, competition for clean shell companies has increased. A shell company can be found in a variety of shapes and sizes. Some will be formal operational companies that have gone dormant. Others have been created specifically to attract interest in an RTO transaction. Some will have cash and other assets and associated liabilities. Many promising shell companies will have an active listing on the CSE, and others can only be found via listings maintained by regulatory authorities or by working with a shell broker. So you can begin the process of identifying a promising RTO candidate by checking lists maintained by the CSE or by collaborating with investment banks, financial advisors, and other professional groups who experience navigating Canadian securities markets. With anything in the cannabis industry, there's a due diligence process. So due diligence on a prospective shell company will be performed by your cannabis company, and the shell company will do the same thing with you regarding your cannabis company. You want to be looking for a shell company with a clean history and no outstanding debts or liabilities. The company, on the other hand, will be taking a close look at your company's fundamentals to assess whether your company is ready to go public and if you and your team have the necessary experience to manage a public company. The two parties will seek to reveal liabilities, determine relative value, and ultimately decide on pairing if it's a good fit. The due diligence process will be demanding legal counsel for all related parties and will probe deeply into each respective company and its affairs by examining financial and business information, conducting discussions with senior management, inspecting operational facilities and associated assets, and reviewing contracts and other agreements. Leadership should be prepared to respond to inquiries that include business and operational performance, industry trends and competition, revenue and sales, customer relationships, accounting policies, and effectiveness of internal controls. If you're wanting to list on the CSE, your cannabis company will need to prepare an information circular containing transparent disclosures for both companies involved in the RTO, as well as management details, governance specifics, and other topics. This will be a prospectus level document that includes many of the same drafting and revenue procedures as you were drafting an IPO prospectus. The RTO informational circular will be drafted in collaboration with the shell company. Leadership and the board of directors for both companies will provide detailed information about the businesses, the material facts, liability disclosures, and other essential information gained during the due diligence procedures. Finally, the information circular will also provide information about the resulting entity and subsequent CSE listing that will result from the RTO. These details will be agreed upon during negotiation of the RTO. One advantage of the RTO process is that the same period of regulatory review and commitment are typically much shorter than that of an IPO. This is partly because the shell company already has a CSE listing and is presumably operating within the guidelines of the Canadian securities regulations. As such, the information circular does not need to be filed with or reviewed by securities regulators. Instead, the information circular will be filed with the CSE to inform them of the change in ownership control of the listing. The CSE will review the document and provide comments. If everything is in order, the CSE will issue conditional approval. Upon gaining conditional approval, you can begin executing plans for the shareholder meeting, which will be held to gain majority support of the RTO transaction. Before completing the RTO, you'll need to gain approval from the shell company shareholders. Depending on the nature of the transaction, the shell company communicating with and obtaining approval from legacy shareholders may be a complex and ongoing matter. Before the shareholder meeting, the leadership of your company and the shell company will need to complete the information circular, which provides necessary information and disclosure about both companies and also provide details about the ensuing entity. The information circular must be printed and sent to the shareholders before the meeting. Upon gaining majority approval of the shell company's stakeholders, you'll file the approval documents with the CSE. The CSE will issue the final bulletin demonstrating acceptance of the listing. Private placement funds will be released from escrow, and common shares of the resulting issuer will begin trading on the CSE. Almost immediately upon closing the IPO RTO, your cannabis company will need to be prepared to meet the regulatory reporting demands of a public company. As such, it's highly recommended that you understand the requirements of operating as a public company and implement all structural, operational, financial, and governance changes prior to closing the transaction. And with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge, your cannabis business podcast. Like, subscribe, and share, or don't. And I'm out.